I'll send this to you, okay, Vivian? So you'll have the recording.
Thank you.
And we are also live streaming on our EXP Family Tree Workplace. So we'll probably have some more people join in because this is going to remind them that we're doing it. It's summertime, and I realize that people are super busy with kids home from school and all those things. So we live stream it so that people can watch it live if they're not able to join our Zoom, if they're out and about, but also so that they can watch it later, because we do, by the way, everyone watching and those of you here, when we live stream it in our EXP Workplace group, it is always in our news feed and it stays there forever. So you can go back and watch it anytime you want. And then Vivian, I'll tag you in that so people can reach out to you within EXP if they want to talk to you further after our call, so that you have that opportunity as well. So I saw Vivian post I don't recall what Facebook group it was, but it was a Facebook group and she was talking about tax strategies for real estate entrepreneurs. Vivian is also a realtor with EXP, right, Vivian?
Yes.
Yes. And so that's how I was able to work chat her. And I was like, this is a really, really important topic. I actually did an in-person event with some of my business partners in Minnesota on Monday. And we had a financial advisor who also is a CPA come in and talk about this in person. And it is just really impactful. Vivian, what she said at the beginning of her presentation really resonated with me. And it was, it doesn't matter how much money you make, it's how much you keep. And a lot of people make a lot of money and they don't keep all the money they could, or they don't use it in the way that's going to impact their finances, their wealth, their future. A lot of it has to, come down to tax strategies. And then of course, different ways to save money and put money in places to save taxes when you're an entrepreneur. So I'm excited for this because I know you're going to bring a lot of value. So I'm going to let you go ahead and run with it. I'll mute myself. And it is already live streamed. I'll monitor the chat box here, as well as if anybody's commenting on the live stream, Vivian, for questions for you. And at the end, we can see if anybody has questions, okay?
Wonderful. Well, thank you. Thank you so very much, Carrie, for inviting me. As Carrie stated, my name is Vivian Truong. I am a CPA here in Houston, Texas. I'm also sitting for the CFP. And the Series 7 and the Series 66, all of these will allow me to buy mutual funds, stocks, and advise clients on investment strategies. I do have a disclaimer to make. This presentation of mine is my own personal opinion. It is not intended as legal counsel or financial advisement. You please seek out a CPA or a financial advisor for matters related to these things. Okay, as a reminder, if you have a question, please unmute yourself, or you could also send me a question via chat. I've been teaching for 10 years, and so I do this a lot. Here are many, many ways that you can connect with me. I am on LinkedIn. I have a Facebook group. I also have a workplace Facebook group that I do believe a lot of people are on already. I'm on YouTube. I don't just teach tax. I teach Excel. I teach retirement planning and many other topics. All of that information is available on my YouTube channel. Okay, what we're going to talk about today are these 5 topics. The 1099 income, the difference between the payer and the payee, what is self-employment tax, what is estimated tax payments, some of the tax business deductions, and the profit and loss statement. I will send this out to Carrie, the slide deck, so that if she wants to, she can send it out to everyone, so you don't need to take notes. And I'm not going to go over all of these details on here, but all of us know that as EXP real estate agents, we are business owners. That makes us independent contractor as opposed to an employee. What that means is that we are, EXP, when they give us the commission checks, they don't withhold any money on these commission checks. They give us all that is due to us. That means at the end of the year, we are responsible for filing all of this and paying taxes. And I walked you through all of that shortly. Okay. And in addition to that, if you, because you are a business owner anytime you engage the services of contractors and you paid them $600 or more, you are required to issue these folks a 1099 also. Okay. So back before 2019 or 2020, before 2020, every one of us was using this form, okay, the 1099 miscellaneous, okay. We no longer utilize this form for people to report non-compensation employment, okay. We are now getting the 1099 NEC. A few of us are still getting the 1099 miscellaneous. So for example, if you have a rental and you have a property management company, that property management company would issue you a 1099 to let you know how much rents they have collected on your behalf. Okay, so that's what that is. Okay, so a lot of people are still getting this form incorrectly. So I do want to make a notation of that. It's very, very important as business owners that we keep up with a W-9 form. This is why I highly recommend that we, all of us, become acquainted with the state broker rooms in the EXP world, so that we can get all of this pertinent information from them and to them. So anytime your name change, your address change, you will need to update this information so that at the end of the year, they have the correct and accurate information to issue you the 1099 NEC. Okay, you know, tax strategies come down to understanding of the tax formula. Okay, so this is a very generic formula, and I'll walk you through all of it very, very shortly. Basically, it starts at the very top. How much income have you made during the year? Okay, it's investment income, it's commission, it's rent, anything. Okay, and then part of some of that income can be excluded, such as some, scholarships. Scholarships are excluded. Okay. Another thing that can be excluded is, some portion of your Social Security benefits. Life insurance proceeds are also excluded. Okay. Munis bonds, interests are also excluded. So those are some of the exclusions that we can use to exclude from income. That will take us to the gross income level. From there, we can deduct for, there are certain deductions that you can take, and we'll walk through that shortly. Okay, and then we can choose between standard deduction, which you can see on the right-hand side of the screen, or itemization. So this is an either or, you pick whichever is higher. Okay, and then because of the Tax Cuts and Job Acts of 2017, we are now eligible as business owners to deduct 20% of qualified business income. There are certain exceptions to this, but a good chunk of us, a good majority of us, will qualify for the QBI deduction. Okay, and then there's credits, and we'll walk through this very, very shortly. I'll pause here if anyone has questions for me. Okay. Okay, so as you can see, since 2017, from gross income, we can deduct the standard deductions. So based on your filing status, you can either deduct $12,950 for 2022, or if you're head of household, you can deduct $19,400, or married filing jointly. All of these numbers are adjusted yearly for inflation. And you can see the 2023 numbers over here. So these are your standard deductions. And you do have an option to pick this or the itemization that we're going to talk about very, very shortly. On top of that, this is what some folks will miss. If you are 65 years or older, you will have an additional $1,400 added to your standard deduction. If you're 65 and blind, you can take an additional $1,400. So if you're 65 and blind, you actually are going to get an additional $2,800. So I've talked about some of the exclusions, and here's a few more. Each and every year, each of us is allowed to give away up to $16,000 every year for each person. And the person that's receiving that money does not have to include that in their taxable income. They have to report it, but it will be excluded, okay? As a lifetime estate exemption, each of us will also have up to roughly $12 million, okay? And when we sell our primary residence, we can exclude up to $250,000 for a single filer or $500,000 for a married couple if we meet both tests. The first one is, have you purchased a house in the past 5 years? And out of those 5 years, have you lived in that house for 2 years? And if the answer to both of these questions are yes, then you can exclude the capital gains, the gains from the sale, and you can exclude that home sale. I've stated that life insurance death proceeds are also excluded from income. Okay, so I'm gonna go back to the formula just so we can see. I'll bring it over here actually. So we talked about income. We talked about exclusions, and then from there we'll get to gross income. We're now going to talk about deductions. Okay. EXP does not have a retirement plan for the real estate agents. However, you are individual business owners. You can and should set up your own retirement accounts. And because you are a business owner, you can deduct the contributions that you're going to put in for yourself. Okay, so that is deductible. Okay, that's one thing. The other thing that is deductible is your healthcare premiums. Again, EXP doesn't offer that, but EXP does partner with an excellent healthcare provider to help us. And the premiums that you pay for that service, okay, is deductible also. So that's what this is. We're still on the deductions for AGI. Okay, if you still have school loan interest, that is deductible also. Business expenses, we're going to talk about that very shortly. All of that is deductible. So we're talking about tax strategies. Tax strategies are all about knowing, hey, what can I do to, fairly and squarely and legally take from my income level and lower it down using exclusions, using deductions. And that's what this is all about. Learning about this formula and understanding how to utilize this to keep what we have worked really, really hard for. Okay, and then finally, let me bring the formula down one more time. So we talked about deductions, we talked about exclusions. So all of these are ways in which you can lower your income, your taxable income, okay, so that your tax amount is lower. Another way that we can bring that down is tax credits. Okay, out of all the three things I just talked about, tax credits are the most beneficial because it's dollar for dollar. Whereas the other ones, they take down your taxable income, but it's not dollar for dollar. And we're going to go over a few of these things so that you know. The first one is the saver's credit. Excuse me, sorry. So the government knows that Social Security benefits cannot be sustained. It is a fact that by the year 2035, Social Security, if nothing else changes, will dissipate, okay? And so therefore, I don't remember the exact year, but there was a law that got passed that said, hey, we need to incentivize people to start saving for their retirement because the social welfare system that was put in place in 1930s is not going to be around, or if it's around, won't be as viable, okay? So they are going to give us money. If you make less than a certain amount, you are going to receive a credit. And I actually, oh, sorry guys. I thought I blogged about this on my website. So if you guys go to accelerate-tax.com and /blog, there will be a blog about this on the saver's credit. But basically, the government knows it is not going, the Social Security is not going to be around. And so therefore, they want us to start saving. The other one is that the child tax credit. If we have kids and they're under the age of 13, we should be getting the child tax credit. It could be $2,000, but this year because of COVID, it was increased. Okay, there's an education credit, which is really important because very few people know, and I want to emphasize this. Okay, so let's just say you are going back to college. You are eligible to deduct some of that money dollar for dollar from your taxable income. So there are two credits, okay? And so please reach out to a CPA so that you can go over all of these details. The other one is a child care credit. You know, when you, again, they want us to work and to pay taxes. And so therefore, tax and credits are ways in which the government are using to incentivize us to do what they want us to do. They want us to work, they want us to pay taxes, and therefore, hey, send your kids to childcare. I will give you some of that money. But as you know, the government will always put in place schemes or mechanism in which if you are a high income earner, the credits that you're going to get is going to be phased out or reduced or eliminated at a certain level. But these are available for all of us to utilize. Another one is earned income credits. This is for people who, despite their tryings and the best efforts, just don't make enough. And so the government is going to, again, come in and say, I'm gonna give you extra money to keep going. Okay, so I have many tax clients who make $30,000. Not only don't pay taxes, but they also get a refund, but they do it all legally and fairly because of these credits and because of the deductions we've talked about. Okay, this is a bit too much, so I'm not gonna walk you through the formula, but I do want to say that the U.S. federal income tax is a progressive system, meaning the more you make, the more you pay. I am not going to go over this unless somebody really wants me to. Okay, so by law, any American whose gross income is over $10,000, if you're a single filer or $25,000 for a married couple or earned more than 400. Please note that is 400 and not 600 from self-employment must file a federal income tax return. Okay. When I send this file out, you can click on this link. It will take you directly to the blog that I had written about this very same subject. Okay, so this is where I wanted to touch on about this formula. And this is really, really important because when my wealthy tax clients come to me, I make sure they know exactly what is on the Schedule A. Because if you don't understand how the government is taxing you, you are already losing, okay, in this game. It really is a game, okay? So if you can understand this, okay. So I'm gonna block this so that you can stay focused on the formula just a little bit. Again, it starts with income. You minus exclusions, we subtract deductions, and then the government say, hey, you taxpayer, now you can choose. You can choose between itemization, okay, which is what we're gonna see on the Schedule A, and we'll walk through that. Or you can choose what I'm gonna just blanketly give everyone in your situation, in your filing status. Okay, so we're gonna talk about what's on Schedule A. I don't know if you can see. Oh, good. I have a blow up version of the Schedule A so that you can see. So there are 1, 2, 3, 4, 5, basically 5 major sections that you can add all together to see if it is bigger than these amounts based on your filing status. So let's just say, I'm single. My aim is to itemize somehow. My itemization is somehow bigger than $12,995. $50. Can you guys see that? That is a bit small. Okay, so that's the goal. If my itemization is less than that number because I'm a single filer, I'm gonna let it go. If it's more, I'm gonna choose itemization. Okay, so medical and dental expenses is one category that you can itemize. However, there is a catch. Let's just say I'm gonna go to the dentist and I pay the dentist $10,000. The government say, wait a second, Vivian, you cannot deduct all of that $10,000. You can deduct some of that. Well, there's a formula for that, okay? And that formula is, let's just say I gave the dentist $10,000 and my taxable income or AGI is 40. I need to multiply that 40 by 7.5, okay? And then so when you multiply 40 by 7.5%, it's $3,000. So then I have to subtract $3,000 from the $10,000. Does that make sense? That the government is telling me you cannot subtract all of the $10,000. You can only subtract anything above the 7.5% AGI. So that's one. Okay. One thing I do want to point out, long-term care premiums that you pay is eligible to be included in this section. Okay. Taxes that you pay. Okay. These are sales tax, local tax. Okay. So this is what's commonly known as SALT. Okay. And you may hear a lot about SALT in Congress right now. There's a huge fight going on because the northern states, I don't know how many of you are from the north, but their properties are pricier than other areas. And so to cap the SALT at $10,000 in a way, in their views, is penalizing them some way. And so they're working to change that. Okay, so but right now it is capped at $10,000. Okay, so right here, Vivian is a single person, and I surely have more than $10,000 in here, and I pay some expenses here, $3,000. So together, 10 plus 3 is $13,000 already. that is definitely more than 12,950. I'm going to choose that. I'm going to choose the itemization. However, that is not all. I also own a house. What I owned, when I own a house and I have a mortgage on it, the home mortgage interest is deductible, including the points. Okay, so I'm just going to say I have about $5,000 on there. So that's 3, 10, 5. That's $18,000. Okay. Another thing that I can deduct or itemize is gifts to charity. You cannot deduct all of it, but because of COVID in 2021, the government has said, okay, it doesn't matter anymore. If you give to charity cash, you can deduct $600 of it, and you don't need to itemize. It will just be taken off. It will just be taken off. I'm trying to look for that formula. As a deduction, okay? So that's $600. But if you do give more, then you want to use that formula. You want to subtract it from here. The last thing that you can itemize is casualty and losses. Since 2017, well, it used to be that we can just, if someone burglarized our homes, we can deduct those losses. Well, the government changed its rules in 2017. You cannot deduct losses unless it is a FEMA declared national disaster. So this happened to me in 2017. Harvey took place, and one of my my house got demolished and flooded. And so luckily FEMA came in and said, okay, it is now, Harvey is a national disaster, and therefore Vivian is eligible to itemize. So I did that. And this year, well, that year, not this year, that year I got a huge amount of itemization that is way bigger than the amount for 2017. I don't remember exactly what it was, but it was way bigger than even $12,950. Okay, so we just talked about itemizations, and I think if not for you, for your clients, knowing the tax rules is going to help them navigate. I get a lot of questions. Hey, I don't understand the tax laws. Can you help my clients? And so this is your way of educating your clients about home ownership. Home ownership is again a way the government is incentivizing Americans to own homes. I'm trying to watch the time. So this is Schedule C. Okay, this is Schedule C. As business owners, as real estate entrepreneurs, we utilize Schedule C to report our income and our expenses. And we're going to walk through this very shortly. Let me see. Oh, okay. I'll go back to this, but I want to touch on this. The difference that I mentioned earlier about a entrepreneur and an employee is that self-employment taxes. Okay, when you are an entrepreneur or a boss, you are both the employee and the employer. Okay, so when you file taxes, you have to pay Social Security tax of 6.2, okay, times for yourself as the employee and for yourself as the employer. And Medicare taxes 1.45% twice. Okay, all of this adds together to be roughly 15.75%. 15 something percent. So but Social Security tax is capped, okay, at $147,000. It's So they can't tax you more than an amount. Okay, however, this is a good thing. Half of this is deductible. Okay, so again, the government wants us to work and wants small business owners to thrive. Okay, so I do want to, a lot of my real estate agents make a lot of money, good money. And they always complain to me about, man, I wish I had known that I need to pay estimated tax, because they don't know. Well, you are responsible for making quarterly payments to the government. Okay, you can just send them a check, or a faster way is to log on to the electronic federal tax payment system to pay them every quarter. And you can just go to the website directly. Let me just type it here. Okay, this is the IRS website that you can go and create an account and start paying for estimated quarterly payment taxes. Okay, so all of this, there's a lot here, but the gist of it is, if you owe the government money, it is due on December 31st of that year, not April 15 when you file taxes. That's when you're just saying, hey, I owe you money, okay? But if you owe the money and you didn't pay after December 31st of the previous year, you are late in paying them, and they will assess you with a penalty. There's an interest. I do believe it is 5%. Okay, so this is, we're now going to talk about Schedule C that I mentioned earlier. So Schedule C, but just a little plug, on my Facebook group, on the workplace and on Facebook, I had said that, if anyone who wants this can email me and I'll send it to you. It's just a simple Excel file so that we can keep track of our expenses, so that at the end of the year, we know exactly where we stand. Not even, and then throughout the year, we know if we're making a profit or we're losing money. In my case, I'm losing money for this year, right? Because I'm spending a lot and I don't have any commissions or payments. So if you want this, just shoot me an email. Here are some of the business expenses that you can deduct on Schedule C. Advertising, auto charges, expenses, bank charges. I'm not going to read all over this. There's two things I want to point out. One is auto. Okay, you should use Mile IQ, and I'm going to say that right here, to keep track of your mileage. It is an app, or it is also there is also a web version on the internet. It's free free for most people. Okay, free for me at least, because I don't travel a lot. I don't go thousands and thousands of miles a week. Okay, so definitely use that so that you can deduct your mileage. The other thing I want to point out is home office deduction, and I may have, yep. So home office deduction, if you have a home office, you should take a picture of it and send it to your CPA. And in that picture, your office should be a place where clearly that shows that you only use it for business. I don't see, a dining table right in the middle of it. Okay, so then you can expand the square footage of that room is $5 per square foot, and you can only deduct up to $1,500. Okay, that's one way to deduct for home office. The other way is, if you don't want to use a simplified version, you can also you can also itemize everything, you know, for example, the office that I'm in is maybe 200 square foot. And then my house is 2,000. So 200 divided by 2,000 is 10%. So I'm gonna deduct 10% of almost everything. I don't recommend doing that. It's just a lot more work for the CPA and for you. So I just recommend, you know, using the simplified version. But it is up to you. Okay, it is up to you. Okay. I have a lot, but this will be my last slide because I want to be mindful of the time. This is so important to me. This is what I'm passionate about, retirement plans for all of us. As I've stated and shared, by the year 2035, if nothing happens, Social Security benefits is not going to be sustainable. That is why we are responsible for our own retirement, and the government recognizes it. This is why they are giving a retirement savings credit. It is now called the Savers Credit. And again, when I give this slide deck out, you can click on this link and it will take you to a blog. Okay. So the other one is that I highly encourage everyone to contribute is the IRAs. Okay, there's a traditional IRA and there's a Roth IRA. Anyone who has earned income is eligible to contribute to an IRA. I don't know if anyone has heard of Peter Thiel, who owned PayPal at one point. He was able to utilize his IRAs to amass massive amount of wealth. And so we should be able to learn some of that and you know, at least support our future retirement. Okay, these two things here is not eligible, is not available, these two things are not available to everyone. They are only available to business owners, okay, such as us. It is the SEP IRA, okay, that you can fund, you as an employer can fund for yourself up to 25%. Not a lot of people know, okay? And believe it or not, it is deductible, okay? You can choose it, you can choose for it to be deductible or not, but it is there and not a lot of people know about it. The other one is a simple IRA. Again, okay, you can contribute money. And again, this is deductible and not a lot of people know about it. The last thing I want to touch on is the healthcare spending accounts. And it is commonly known as HSAs. Okay, this is only available to people with high deductible healthcare plans. Okay, so I do believe I have a blog for this, but this is one of the best way. I also think it is better than the IRAs. If you can afford it, do both. Okay, but the HSA is amazing. So please look into these retirement plans and start paving the way for your bright future. With that, I have 3 minutes left. I will stop for any questions anyone may have for me.
Great information. I love this last slide, you guys, because so many of us are paying a lot in taxes. And if we paid ourselves, we would save money in taxes. And at the end of the day, you know, we wouldn't spend as much as we would think in paying ourselves because we're saving so much in taxes. This is a big one. And you can start with even, right, Vivian, $100 a month. I mean, whatever it is, but you should start. If you don't have some of these set up, you definitely should. Remember also, here at EXP, you guys have the Agent Equity Program. If you are taking advantage of it and you're getting money put into your account because you are having stock purchase at a discount in your name, that is liquid. And if it makes sense, and you would want to talk to somebody to make sure this makes sense, but it's liquid. So if you wanted to take that at the end of the year and invest it in something else and actually save the taxes and start doing that, you could put it in a SEP or a Roth or something of that nature. You could keep it in the stock account as well for retirement, but there's probably some options there because that is liquid cash. So but you know, truly, this is something I wish somebody would have told me earlier on in my career, because as you start making some good money, it is really, really important to start putting some of it away. So I love this last slide. Does anybody else have any just specific questions on tax strategies or anything that Vivian covered? We'll definitely send this out or attach this file in EXP Family Tree when she sends it to me as well, so that you can look this over. But please unmute yourself if you do have a question. I'm going to look and see if anybody's asking on our live. We do have a number of people watching live. So if you're watching live on Workplace, you guys, you can chat. Just comment on this live stream and ask a question if you want right here as well. Any questions? I know tax strategies and retirement is a big, heavy subject, but hopefully you got one action item, like I just don't do this and I need to go do something. Hopefully you took one thing away that you can go execute on today. That's really what this is about. Is, again, you're not going to solve all the things that you need to solve in regards to retirement and taxes in one session. However, if you go, okay, I could do this one thing, let me just go set up a Roth IRA. And let's put $50 a month in, or every time I get a transaction, put X amount of dollars. That would be a great action item. Lynn said really good information. She took several screenshots. Good. So you'll have some reminders and you can have some takeaways to go do something with. Anybody else? All right. Well, we don't have, oh wait, we do have somebody watching live, and she just said, what did she say? I gotta move my screen so I can read it. Oh, Rebecca Ricker is watching. Hi, Rebecca. She said, lots of great information. Thank you so much. We have, 10 people watching live right now. So you had some good viewership, Vivian. I think you brought a lot of value. I know people have to process a lot of this because, as you know, a lot of this is just new information, and it's a lot for entrepreneurs to think about. You can go ahead and search for Vivian in Workplace, and you can work chat her if you have any questions as well. So please feel free to do that. She is part of our EXP family. And this is live streamed in EXP Family Tree. So just want to make sure you guys know you can go back and watch this if you'd like to. Thank you so much for your time, Vivian. We really appreciate you. You're full of knowledge, and we're excited for you to continue to get some of those additional licenses. And if there's anything else that you'd like to dive deep into and you'd like to train on, please let us know, because we always welcome the information here in EXP Family Tree.
Well, thank you for the invite. I really, really enjoyed it today.
You're welcome. Thank you guys. Have a great day.
Bye, everyone.